Okay, good morning, everyone. So last time, what did we do last time? Last time we went over the legal part of describing what a company is. We haven't talked about other types of legal entities like partnerships, okay, a sub S company. There's a lot of types, but we want to focus on corporations. So we talked about how you establish a company, how you raise money for the company to start operating by way of issuing stocks or by way of taking a loan, or you take a loan from the bank or you issue bonds. Issue bonds are already taking a loan from the public. Everyone in the public giving a small loan to the company, total, they have a big loan. Then we talked about companies start doing business. They have to have agent. So they appoint CEO, they appoint CFO, they appoint human resources general, and all of those carry executive function in the company. In addition, we talked about it, that the shareholders, we call them the owners of the company. They usually gather at least once a year. They appoint the board of directors. The function of the board of directors is to monitor the work of the executives. They usually are in control of what known as the internal control system of the company. And the internal control system job is to make sure that the company is running according to the rules of the board slash articles of incorporations of the company. That was the legal element. Then we start, okay, now that we know structure of the company from the legal point of view, what happened to the accounting? Accounting meaning when a company does an action, does a transaction, how is that reflected in the financial statements? We mentioned that there are four financial statements. One is the balance sheets. Balance sheets basically showing me what assets the company has, what are the loans or who they owe money to, and how much money the company have raised from the owners, meaning the shareholders. Okay, so we mentioned the balance sheet, then we mentioned the income statement, but we haven't done really much. We talked that the income statement showing what happened during the year, how much revenue come to the company, meaning how much money we already collected. We show the expenses and the net, meaning revenue minus expenses, give me the profit. We didn't get into the detail, and we will see there's more detail to this general structure of balance sheets and income statement. By the way, those two statements are extremely useful. They are the most used. In my opinion, statement of cash flow is not less important. But as we will see, mostly today, statement of cash flow, it's derived from the first two statements. Okay, so it means if any transaction the company it does affect directly what happened in the balance sheet, what happened in the income statement, you can build the statement of cash flow just by using the income statement and the balance sheet. You already can construct the statement of cash flow. That's from the technical point of view. But so if I can derive it from the balance sheets and the income statement, you could ask, so why do I need it? I can have the same information in those two reports, those two statements. Why do I need another statement? And the reason is, it's the way you classify the information. By reclassifying the information and reorganizing it, you can really get a better insight of the status of the company. And that's the main reason why you do it. Then you will see when we get to corporate valuation, we can derive very important numbers right directly from the statement of cash flow. Because in the statement of cash flow, there will be two numbers that we can start and look at them and use them in the corporate valuation. Okay, so that's the link between those three statements to valuation eventually. There is one more statement of a change in equity. The truth of the matter, as I mentioned last time, in the US, they call it a schedule, not as a statement. The reason is because it's come to shed light on what happened in the equity in the balance sheets over the year. You know, I have the beginning equity, and we said what equity is really how much money I raised from the owners of the company. If I raised more money, the equity will go up. If I distribute a dividend, as we will talk about it today, and what dividend means, the equity goes down. Okay? Sometimes the company could rebuy the stock. It will reduce also the equity. All of those I haven't talked last time, but I just wanted to mention it's in the beginning of this session today. We'll talk about all of those today. I built very good case studies so you can learn from it. In the future, I'm expecting you guys, as you learn more and more, even expand and build up more cases to what I have done. Now, how will you be able to do it in the future? And that's what I said, this course should be only for senior students. It's because the next topic you will learn in Django is how will you build a plug-in. The component I'm using called the plug-in, something you haven't studied yet, but you will. That will be one of the next topics that we will talk. By the way, I will start sending you advanced topics. Today, this morning, I just sent you a topic called manager. I haven't taught you manager. Very important. Okay? It's a very advanced topic. Okay? And we will learn about that and how you can really write functions, or how, if you have a table, and from one table, you want to do summations of another table that depends on the first table. That's very advanced topic. So managers try to struggle with it. Look at the examples in the document I sent you. Try to learn it. We will not do it in this course, but in the future, you will want to learn that part, and I want you to get to the level that you can really enhance what I already have done in the plugin that I created. So let's start. Oh, sorry. Let me go here. Let me start a new one. I will log in as we usually do, as under FSA. We go to my account, we'll go to management, and this is the courses I'm registered to. This is giving me the financial statement analysis course. We'll use the other link next time, you will see. Okay, so we are still in number 4. We're going over those cases. This is a very nice plugin. This is, by the way, known as a plugin. And you will learn how to do something like that in the future when we talk about in the course framework for software engineering. Okay, let's start from scratch, do a review of what we did last time. We established new company. All the 3 financial statements are empty. We don't have any assets, we don't have any inventory, we have nothing. Company is empty. This is really the situation right after we incorporate the company with the Minister of Corporate Registrations. And we started. What is the first transaction usually a company does? Just as a review, we raised money from the owner. By law, by the way, in most of countries, shareholders have to contribute some money. I will add something more. If you recall last time, I said that every share, it's like a contract between the company and the shareholders. Every share has a number on it called par value. Let's say the par value in the example here that I'm using, each one of them is $1,000. This par value, its amount, usually the company will collect $1,000 from the shareholders for every share they're giving the shareholders. So if I'm raising 50,000 and the company is selling, you can call it selling, in fact, you can call it, a better term is issuing shares to the shareholders. Every shareholders, let's say we'll put $1,000, will end up in the company having $50,000. But as we will see in the future course in the corporate valuation, I will dive much deeper to that. When we get into maybe the 5th session of this series, okay, I want to make a decision if I want to include merger and acquisitions and a little relative valuation maybe. I will explain that the company don't have to collect only $1,000. For now, that's what we will assume. The company is issuing one share, let's say, to a shareholder, they collect $1,000. Now that $1,000 called par value has a special name. The company, by law, after it's established, cannot give back the $1,000 to the shareholders. Okay? We will see a company can buy back some of that shares back, but they cannot use the same money to rebuy the shares. What do I mean by that? Let's say the company, transaction number 1, they issue 50 shares, they have in the bank account 50,000, and we have in the equity, in the common stock, 50,000. Let's say the following day, while the manager said, well, we don't need that much money, or whatever reason is, they want to buy the share back. They are not allowed. They are not allowed. Why? Because it's give a guarantee kind of to anybody that deals with the company to know that the shareholders have put some money. So if I give a loan to the company, I know that I have some security. And let's say I gave $2,000 loan to the company and the company went bankrupt. I will be the first one to get the 2,000. The shareholders, whatever left, that's what they would get. So I gave the company a loan of 2,000. I felt comfortable. Why? Because I know out of 52,000, if the company even losing money, still there will be left 2,000. But what happened if the company was paying back the 50,000 to the shareholders and I gave them 2,000 and they go bankrupt, they won't have money to give me back. I will give an example just for hypothetical situation. They issued 50,000. They came to me, they took 2,000 loan from me. And they paid the whole 50,000 to the shareholders. They gave it back to them, most of it. If the company will lose 2,000, I lost my money as a debt holder. And the corporate law try to protect the debt holders. And the way they protect it is saying, oh, no. You issued equity, you cannot buy back the equity. There is a situation you can buy. We'll talk about it later on. And I will just mention now, you can do it from profit. If you have profit, you can go buy back some shares. But that's a different topic. When I talk about dividend, I will talk about that topic as well. Okay? And that will make more sense. For now, we just need to know that when a company issues stock, they cannot buy those stock back for now. Later on, we'll give the circumstances under which they can buy back the shares. Next transaction we talked about is when the company takes loans from the bank. And we said if the company takes a loan from a bank, the bank account of the company will go up. Is that right, Brenda? If the company takes a loan of $600,000, what will happen to the bank account of the company? It will go up by 600. Is that correct?
Yes.
Correct. Here, the second transaction, if I click on it, you will see the bank account of the company, since they got cash from the bank, they put it in their bank account, and now they have total of $650 in their bank account. Now, where that money came from, we can know from the balance sheet. Why do we know it from the balance sheet? Because when we raised 50,000, we wrote it in the equity, because that money came from the owner of the company. The 600, we took a loan. That's the second category in the balance sheet. Equity is one category. Second category is liabilities, meaning taking loans or receiving loans. When the company receives loans, it will be in the liabilities. So if they took a loan from a bank, they owe the bank 600. When they raised money by issuing equity, issuing stocks, they got 50. The total of those two must equal to how much money they have in the bank account. Daniel, does that make sense?
Yes, doctor, it makes sense.
Great. So if you remember, I told you, okay, let me open another one here so I can go back and forth. In fact, it's already in the bottom. No, it's in another folder. Let me open another folder so it'll be easier to go from one to another. I mentioned to you, go ahead and read this document. This is a beautiful document. And this equation, that's called the accounting identity. So it is by definition. Why is it always hold? Because the assets will always be equal to liabilities plus equity, which it means that the total asset that we have for now, it's only 650 because we have only cash in the company. The total assets will be 650. We'll talk about these categories in a second. But the total assets is only the cash, and it must be equal to the liabilities, which is 600, the loan we took from the bank, and also plus whatever we're raising from the equity owners. Okay, now let's move to the next example, okay, which is a little jump, because we start talking about the company start doing real business. Up to now, they just established the company. They raised money, and now they're going to use the money to start doing business. What is usually the first things the company does? Let's say you have a shoe store. Let's just take it as an example. We can use any example in the future, but just for the simplicity, let's say this company have a chain of stores in many places in Uganda or East Africa or US or Europe, doesn't matter where. So the first thing is usually if you have a nice design shoes, you buy a lot of shoes and you start selling them. When you buy shoes, you go to the supplier and you say, I would like to buy from you such and such amount of shoes. But listen, can you give me a little credit? What does it mean, credit? I will buy the shoes from you, but I need some time to pay you for the shoes. That means buying on credit. Many times a supplier will do that, usually with somebody that the supplier already have business with. First time, usually they won't give it to you. But if you are in a good relationship with the supplier and you're already buying for him for several years, he knows you pay on time, they will give you shoes on credit. What means is, if I go to a supplier and say, I want $800,000 worth of shoes to buy from you, but give me please 90 days to pay it. So it means like the supplier sold you shoes and he give you a loan. So what already happened in the merit of this kind of a transaction? The company now will have a lot of shoes in their warehouse, or they will distribute it to all the stores they have all over Europe. And that will be the assets. It's an asset, a new asset they will have. On the other hand, they owe money to the supplier. So if I look at the balance sheet, I will see that the inventory, which reflect how much money I spend on buying those shoes, will have 800. That should go up by 800 if I got shoes from the suppliers. On the other hand, since I haven't paid for it yet, I will have a loan from the supplier of 800. Again, pay attention what happened in the transaction. The assets will go up by 800. The liability this time will be a short-term liability because I'm getting a loan from the supplier only for 90 days. And by the way, definition of a short-term debt or current liabilities, it's any loan the company receives which is less than a year. That's the conventional definition. There's some differences a little bit, but this is really the most common definition. So if I got it from a supplier a loan for 90 days, that will be a current liabilities. If we click on the button, the third one, and if you read the description, and you should, as I asked you last time, buying inventory from suppliers on credit, the effect of it on the statements, on the three of them, let's see, as we said before, I clicked, oh, inventory went up by 800, liabilities went up by 800. Please pay attention. No effect on the income statement. I'm skipping for now on the statement of cash flow. Why am I skipping? Because it's a little hard. And I want to do it when we redo the whole thing again. It will be a review. And then we can focus also on the statement of cash flow. So we'll do all those transactions twice. One to focus on the effect of every transactions on the balance sheets and income statement. And then we'll redo the whole things again. We'll review how it affects those two statements, and then we talk about the statement of cash flow. Okay, so let's move on. In this point, the company only bought shoes. They haven't sold anything. You really don't have any revenue. You really didn't make any money yet. You just bought shoes. When you buy shoes, when you buy product you want to sell, you're not really making a profit yet. When do you make a profit? You make a profit when you take some shoes and you start selling to the other customers, Let's say you bought the shoes for $20. You're selling it for $100. You make a profit of $80. Profit shows in the income statement. But selling goes into the income statement. Let's say, and let's look at the transaction number four. It's a hard one. Transaction number 4, it's a little hard one. In the future, I might break it up to 2 transactions. Why is it hard? Let's read what the transaction is about. Number 4. The company, during the year, by the way, made a lot of sales. And I look at how much they sold. And I discovered they sold a lot of shoes. And they charge customers $1,274, meaning they sold a lot of shoes, and every customer that come to the store, one of them I sold it for $100, some of them I sold $20. I might have a lot of types of shoes. But how much money did I collect from my customers? The total amount I collected from all my customers, it's called revenue. I repeat, the total amount I collected from all my customers during the entire year, it's called revenue. So if I collected 1,274, it will show in the revenue. It should show here, 1,274. Okay, that's how much money I collected. So far, so good. That's what I should collect it. It doesn't mean that people give me the money. Let me give an example. Let's say Mildred came to my store with her father. She really liked some shoes. She bought a couple of them. Total was $250. And her father said, you know what? I don't have the cash on me yet. I have only $100. I will pay you later on the other $150. What really happened is I sold shoes to Mildred for $250, but I didn't really collected all the $250. I only collected $100. So my revenue is really $250. Why? That's the amount of shoes I sold. That's the amount of money I'm expecting to collect, part of which I collect immediately, the $100 in my example, and the remaining $150 will be paid later on. Whatever amount that I'm expecting customer to pay me in the future, usually in the short term, usually I don't sell shoes. When you go and buy shoes, most of the time you pay cash. Sometimes they give you to pay within 30 days, or they might say, okay, on the credit card, you want me to break it down to 5, 6, or 12 payment? They might do that. The amount you don't pay right away, it's called account receivable. Account receivable, it's in the balance sheet. So the amount that a customer promised to pay on inventory they buy, in my example, it was shoes, it's a promise to pay in the future. So when I'm selling shoes for the amount of $12,074, now we'll go to the example that we have in transaction number 4. When we say we sold shoes for the amount of $12.74, that's my revenue. But the example says that we gave credit to customer of $7,000. In another word, we didn't collect all the amount in cash. We only collected the difference. 1274 minus 7, that's the amount of cash we collected from customers. I hope that's clear. The transactions, what happened? You know, businesses over the year, they're selling a lot. Some of them give them credit, buy the credit card, they split the payment. So whatever they didn't collect it from the credit card yet, that's giving a loan to the customers really. And how much money cash went to the bank account of the company in that point? Only the difference. And what really, if I think about it, I really supposed to collect 1274. I have now two types of assets in the company. I will write it and then I will do the whole transaction as I usually do by clicking on the bottom. I sold 1274. That's my revenue. I really should have extra cash, whatever the customer paid me in cash. And whatever they didn't pay me, they will pay me in the future. So the 7, they will pay in the future. And the difference I should add to the 650. In another word, the 1274 that I sold to the customer, part of which they're going to pay me during the next year, because I gave them a loan, and the rest they're paying me in cash. So my bank account should go up by the amount of 1274 minus 7, which is 1267. If I take 1267, add to it the 650, 12, that will be, it really should be 19, I hope I'm doing it right, 1917, I think. In a second, I will do exactly. By the way, you can check if you did it correct, because now, you know, you have the total assets went up by this 1274. This is my revenue. By the way, it's still not the end of the story, and I will explain in a minute why. But for now, my profit or my revenue 1274. By the way, I have to make a comment. It's very important comment. This is really not my profit yet. But this is really what I collected, 1274. 1274, as I will explain in a minute, will be added to the bottom here. So if I really want to check my mathematics, I see 2724 is the total assets, and we said they always have to be balanced to be equal to the total assets. So I see that they are correct. So this is probably I did the math correctly. I did it by heart. So this is correct. I will go over it again. Don't worry. It's a little hard. This is one of the hardest transactions, by the way. Let me go back go all over it again, and then I will add one more element to the story. We said we sold inventory shoes to a lot of our customers during the whole year, and we collected 1267. We sold for 1274. We gave some credit to the customers, and the remaining we got in cash. That's why we have a lot of cash in our bank account. But hold a second. What happened to my inventory? When a customer comes to the store, he takes shoes, and with that shoes, he goes home. So what happened in my store? I have less shoes. Is that right? Jeremiah?
Yes, doctor.
Is that right?
Yes.
You know, when you come and you buy shoes from the store, or you pay, or the store owner give you a credit, but you walk out with the shoes. What happened to the amount of shoes we have in the store goes down. It will go down. And now, by how much does it go? Here we're counting it according to how much it cost us. If we read the story of number 4, by the way, the reason I did this one, I wanted to No, this one. Yeah. Let me go back down here. If you go and look at the story number 4, that tells us, by the way, here is the calculation that you will have. We have to have 1917. And there is another very interesting number. 791. What is this 791? The story tells us that when I gave shoes to the customers, my inventory goes down. I have less shoes in the store. And they tell us the amount of shoes that I gave to the customers, it was worth me. I bought it from the supplier for 791. I will repeat. So far, I had 800,000 shoes I bought from the supplier. I sold it to the customers, so I have much less shoes left. How much out of the 800 have left the store? The store tell me that the amount of shoes left the store was worth 791. So I have to say, okay, I don't have any more 800. I need to reduce this amount of 800 by 791. How much is it? 800 minus 791. Anybody? 9. So I have only 9 left. Oh, hold a second. Now it's the hard part. I sold shoes to the customers. They have taken some inventory from my store. The amount of shoes that I gave to the customers cost me 791. So how much profit did I make? How much money profit did I make? 483. One more time. I sold shoes to the customers. They promised to pay me 1274, some of which paid me, and I put the money in the bank account. Whoever didn't pay me, he promised. So I write the promise in the balance sheet. Second, I have some inventory left the store. I have left only with 9,000 shoes in the store. The rest I gave the customer. Okay, I sold shoes for 1274. It cost me 791. So how much profit did I make? The difference, 483. 483,000, it's profit that the company has made by selling shoes. I hope it's clear. It's a really hard one for somebody that never have done accounting before. This is one of the hardest transactions. So bottom line, I sold shoes for 1274. It cost me 791. Profit 483. By the way, if you look at the balance sheets now, it will not balance. Why it will not balance? I reduced the inventory by 791. And by the way, there's a magic number. What is this 483? This 483 comes from the income statement, right from here. It must be here. Otherwise, it will never balance. And by the way, you see, by putting this number right from here, it will always balance. It will always balance. I have 1933 total equity plus liability equal to the total assets. For new student, it's puzzling. They always get confused. Why is it true? So what I'm going to do now, I'm going to make all those 4 transactions one more time, and then go over the 4th one and explain it again. It's worth the repetition. So I'm going to refresh the page. We raised 50,000, we have 50 cash, and we have equity 50. Second transaction, we raised money by issuing debt. So we have 650 cash, and we have also a liability 600. Balance, yes. Total assets, 650, that's the cash we have. We have 650, it's the total of loans we took from the bank, and 50 we raised as equity. Transaction number 3, we bought in credit 800. So if I click here, oh, we got inventory of 800, and we owe 800 the supplier. Again, equality, 1400 total assets. For now, we have only current assets, inventory, cash, they're all current assets. And we'll explain that one more time, what exactly we mean by current assets. And then the total assets equal again, total liabilities. Why? We owe the supplier, we owe the bank, 1400 total, and we raised money, 50. So total 1450 equal to the total assets. Then we have these complicated transactions. I will click on it. And what happened? We sold for 1274. Our inventory went down by 791. One more time, if you look at that, our cash went up and our account receivable went up and our inventory went down. So if I look at those three together, my cash plus the credit, it's exactly the 1274. In fact, the 1274, we split it. We added to the cash whatever got as a cash, and whatever we didn't get paid, we put the 7 here. But the bottom line is the cash plus the account receivables went up together by 1274. On the other hand, inventory went down by 791. So if I look at those three numbers together, this went up together, they went up by 1274. This went up down by 791. If I look at those three together, they went up by 483. One more time. Those three accounts went up by 483. This one plus this one went up together by 1274, and this one went down by 791. Total, those three went up by 483. Now, in order for the balance sheets to balance, we must increase the equity. Why do we increase the equity? Because this increase in the asset is really a profit, and profit belongs to the owner of the company. This 483 belongs to the owner of the company. It belongs to, this is really the profit of the year. It belongs to the equity owners, to the owners of the company. That's why we put it there. I hope that's clear. Is that clear, guys?
Yes, doctor. Yes, doctor.
Beautiful. Michael?
Yeah.
Okay, Michael. Why do I put the 483 here? I put it for two reasons. One, it has to be there because it belongs to the equity owners. This is my profit from buying and selling shoes. I didn't sell all the shoes I bought. 9,000 have left in the store. But whatever I sold, and I kind of sold it for 1274, part of which I got in cash, part of which people promised to pay me. Bottom line, my current assets went up for 483. So Michael, if my total assets went up by 483, it went up in the amount of my profit, and that belongs to the equity owners. Now, if I add it to here, and this one I change to be extra 483, the balance come back again. Total assets, it's 1933. Liability plus equity will be again 1933. I hope that's clear. Okay? How are you doing, Jeremiah?
I'm doing okay, doctor.
That's clear. That's a hard transaction, by the way. It's a really hard one. The next one is a little easier. The third one, now I have cash. I sold shoes. I have money. Hey, I get a phone call. The supplier said, hey guys, remember, I sold your shoes. It's about time, pay me what you owe me. Or pay me at least some, or pay me all of it. So that's transaction number 5. Let's see what does it say. Transaction number 5. It says we paid the supplier, but we didn't really pay them the whole amount. We owed them 800, remember? But we didn't pay them all the amount. We paid them only 768. Meaning, by the end of the day, although we pay them, we still owe them some money. Okay? We will owe them 32. Why 32? We owe them 800. If we pay them only 768, we will owe them 32. What happened to our money in the bank? We're paying the supplier, so our money in the bank will go down. So let's think about it one more time. Please pay attention. The transaction number 4 affected the balance sheets and the income statement. This transaction, paying the suppliers, does not affect the income statement. What's really going to happen is, since I'm paying the supplier only 762, my cash has to go down by that amount. And my liability, or how much I owe the supplier, will go down. Everybody got it? So I will have less cash because I'm taking some money from the bank and give it to the supplier. So I will have less cash and I will owe less money the supplier. So this one should go down by 632 and this one should go down by 768. So let's see, if I click on transaction number 5, say the 9 things. This one went down to 32, as I said, and this one went down by 768, will have less cash. No effect on the income statement. Is it balanced? Definitely, it has to balance. I reduce the cash and I reduce the debt. Must balance. Total assets, 1165. Total equity plus loan, it's 1168. Also, paying suppliers has effect only on the balance sheets and the balance between assets equal to liability plus equity still hold as we have it in the equation here. Assets always equal to liabilities plus equities, and we see that this holds also after our 5th transactions. Questions so far? By the way, it's not easy stuff. I know people get confused. Okay, they do. Daniel, you doing good?
Yes.
Good. Let's go to the next transaction. Let's go to the next transaction. The 6th one. What do we do in the 6th one? By the way, 6th one is really also not hard one. It's not as hard as the other one. And let's see what do we do. The company said, wow, we have money now. Let's go buy some building. That's how we buy a building. I don't know what I wrote in the story, but the same things. PPE means property, plant, and equipment. I repeat it. It's a acronym very used a lot in accounting. Property, plant, and equipment. If you go and look, number 5, let me see what the story said, okay? Sorry, number 6. The company is going to buy some assets. Which asset did I say? They bought equipment. Doesn't matter really. Equipment means machinery. By the way, anything that is going to last for the company more than a year. That's what distinguishes property, plant, and equipment from inventory. Inventory I buy to sell to customers. If I buy a building, let's say I buy some equipment to the stores, I might put shelves in the store. I might put some equipment inside the store. All of those equipment, or if I'm manufacturers, I might buy some machinery. There will be equipment for the company if it's a manufacturer. All of those going to last most of the time more than a year. So anything that are going to last for the company more than a year will go into property, plant, and equipment. There will not be inventory. Inventory is only type of an asset I'm going to sell customers. Equipment that I'm going to use in the business to carry out the business, they are property, plant, and equipment. So if the company has acquired equipment for $400,000, what's going to happen? Very simple. This is an easy transaction. Why? Because what's going to happen, I will have 400 cash less. My bank account will go down if I paid for cash. On the other hand, I will have another asset called property, plant, and equipment. By the way, in the detail, when we will look at real financial statements, as we will do in the future. In fact, next session we will, or the one after, we will see that we might specify which kind of property, plant, and equipment. Is it machinery? So we'll write machinery 400. If we bought a building, we'll write building 400, whatever we bought. So we'll give more detail. Many times those details will be like kind of a notebook or note that we'll write down, okay? And we'll say, oh, you know what I have in property, plant, and equipment? I bought machinery. And then the user know what really it means or what it does it include. Sometimes some companies have buildings, machinery, and a lot of others type of assets. For now, for simplicity, we say the company have purchased some machinery. And if I click on number 6, see what happened? Nothing gonna happen in the income statement. Again, transaction number 6 has no effect on the income statement. Why? Very simple. I just bought a machinery. I didn't sell anything to the customers. Nothing goes out. So nothing going to have effect on the income statement. So let's click on number 4 and see what happened. Indeed, see what it did. It reduced that one by 400. It used to be 1100. Remember? 49. Now I have only 749. 400 less. Sometime I have equipment, 400 more. This type of transaction, what did it do? It reduced one type of an asset, which is current assets. Why is it current? Because it's like cash. Or now I'll give the exact definition of current assets. Current assets is cash or any assets that most likely going to be turned into cash within the next year. So cash, is current asset. Inventory, most likely, if I didn't sell it this year, I'm going to sell it most likely next year. So the inventory will be current assets. Account receivable it's current assets. Why is it current assets? Because most likely, I'm not going to give a loan. Somebody bought from me a couple of shoes. I'm not going to give them a loan for more than a year. So most likely, whoever bought from me this year is going to pay next year. So that's why the 7 is also current assets. So if my cash went down by 400, my current assets goes down by 400. On the other hand, definition of a long-term assets. Long-term assets are assets that are most likely going to stay in the business for more than a year. So if I bought a machinery that I'm going to use for 5, 6, 7 years, let's say I bought a truck, that's going to be most likely for more than a year. That will be a long-term asset. So buying a truck, buying a building, buying machinery, all of those are assets. They're all property, plant, and equipment. All of them most likely are going to hold in the business for more than a year. So all of those will be in the long-term assets. So now we know the difference. Why we in the assets section, we have two subcategories, current assets and long-term assets. Anything for less than a year will be categorized into current assets. Anything above, or I'm going to hold it for more than a year, going to be in the long-term assets. And this transaction, number 6, already have effect only on what happened in the current asset and the long-term assets. I took some cash out of the bank. That's reduced my cash in the bank. And I bought another asset. So I have more long-term assets. Net effect, total assets haven't changed. Nothing else have changed already. Nothing have changed here. Nothing have changed in the income statement. I haven't used anything. Okay? So that's also relatively an easy transactions to follow. Let's go to the next one. The next one is slightly hard. In fact, the next two are kind of similar. For student, they're a little hard. And let me explain. Remember, we took a loan from the bank. In the very beginning, transaction number 2, we took a loan from the bank. Hey, by the way, what banks do? They charge us interest, remember? Now,
Yeah.
pay attention. When a bank charges us interest, that's in addition to the fact we have to return the loan back. So by the end of the year, how much we owe the bank? We owe them the 600 we received, and in addition, we owe them the interest. Correct? So far, so good?
So good.
Yeah.
Okay. So if it really depends on the condition and what is my contract with the bank, if I said to the bank, I will pay you every year the interest in cash, meaning my cash would go down by the interest. So let's read the story exactly as I wrote it in number 7. What does it say in number 7? In number 7, it says the company pays interest to the bank for the loan for 130. Let me see, how did I pay? Did I pay it in cash? So what's going to happen if I paid it in cash? My cash goes down by 130 because I paid it in cash. But hold a second. What happened now? In fact, for my profit, I have less money left. See, my cash is going down by 130. My cash is going to go down by 130. What else is going to change in the balance sheet? Inventory is not changing. Nothing is changing. My asset is not changing. What does it mean when a bank is taking 130? That means I have to use my profit, whatever I made profit, I have to take part of that money that I got from my customers and give it to the bank. That's really what happened. So the fact that my bank account goes down by 130, that means that my profit goes down by 130. And this is slightly hard. My profit will go down by 130. By the way, when it goes down by 130, that means my net income goes down by 130. My profit went down by 130. But I would like you to look at it one more aspect. When my cash goes down by 130, that means that I will have now 619. I will have less cash, less assets. I should have, by the way, how much do I have? Less asset, the total asset, 1035. This decline in the cash is really also decline in the equity. Why is it decline in the equity? Because my profit went down by 130. So this is the beauty of the accounting. When the cash goes down because I'm paying the bank, that means my profit goes down by 130. And we said that the bottom line here always go down to the equity. This is going to go down by 130. The entity, the accounting identity remain. When I pay interest, my cash going to go down, the assets going to go down, and my equity going to go down because my profit is going to go down by 130. And that's why the accounting identity remain in the balance sheet. That's a little hard transaction. So let's go back again. When I pay interest to the bank, my cash goes down by that amount and my profit goes down by the same amount. Okay? Let's do the whole things again, one by one. I delete everything and do a review. I always love to review. Issuing equity, give us cash, equity goes up by 50. Taking a loan from the bank, we have more cash, we have also a loan. Total loan plus total equity, 650 equal to total assets. Next, we're buying equity from the suppliers, but they give us a credit. We have more assets, so our total assets goes up by another 800. Total assets it's 1450, but now we owe the supplier 800. So our all total liability goes up by 800. Therefore, total liability plus equity will equal to 1450. Accounting identity remain. Next, the hard transaction. We sell some of the inventory. We sold it for $12.74, but we gave credit to the customers. We gave a credit of 7 to the customers. So our cash don't go up by the total $12.74. It goes up by only $12.74 minus the 7. That's what this one goes up. But the total of cash and account receivable together goes up by $12.74. Now, on the other hand, since we sold some of the shoes, we have less inventory. The inventory goes down by the 791. That's cost of revenue, or is it non-cost of goods sold? That's how much it cost me to buy the inventory that I sold. So the difference, it's a profit. So whatever the increase, the net increase of those three accounts, it really is a profit. And that profit belongs to the equity owners. So this number is always come from here. We will see a slight change in the future when we get to the dividend, For now, this number will be always equal to this number. Equality, yes, 1933, 1933. Transaction number 5, we paid the supplier. We got a lot of cash, so we said to the supplier, we're going to pay you a lot of money. Not the whole amount, but almost the whole amount. How much we paid them? We paid them 768. So how much we will owe them? 32 in the end of these transactions. Our cash will go down by the same amount. Let's click. Yeah, our cash went down by the 768, and my debt to the supplier went down by 768. Total liabilities went down by 768. My total assets went down by, my liability went down by 768, and my cash went down by 768. Again, the total assets equal to liability plus equity hold. Next transaction, we bought some machinery for 400. Buying machinery, we said the cash goes down. On the other hand, we have a new asset. So total assets didn't change. Therefore, it will remain equal to the total equity plus total liability. Next transaction, that was a little hard. We're paying interest to the bank. Paying interest to the bank, it means it's like somebody took some of my profit. The banks took some profit of my money. They took some amount from the profit. So my profit goes down by 130. So my profit goes down. In another word, my cash goes down by the 130 and my profit goes down. Therefore, the identity remains. Total assets, 1035, equal the equity plus liability, 1035. That's what we did so far. Let's do one more transactions, which is also kind of another type of transactions. By the way, it says investing in subsidiary. Let me explain what subsidiary means, and we'll come back to that when we talk about merger and acquisitions. You hear a lot in the news, Google have acquired another company. You hear in the news, Microsoft acquired another company. You know, acquiring another company, as we'll see in the future, it's just like buying machinery. I can go and buy a building. My cash goes down, and I have a building. As we said in transaction number 6, when I bought the machinery for 400, my cash went down by 400, machinery went down by 400. When I go and buy another company, I won't get into the meaning, the deep meaning of it. For now, for us, we use some of our cash and we buy another company. So we own another company. What does that mean deeply? I will explain in another session. For now, it's just like buying another machinery. So what's going to happen is really, my cash is going to go down by that amount. And I have another, we usually make a separate account, we call it subsidiaries. The truth of the matter, this is a big topic. It's a huge topic in accounting. I'm not going to get and dive into it today. It will be too much. For now, I want you to remember buying another company is just like buying a machinery. Therefore, the effect of it will be that my cash is going to go down by the amount that I paid for that company. Investing in subsidiaries, meaning buying another company. How much did I pay? 300. So I'm expecting my cash to go down by 300, and I'm expecting here, like we had the property, plant, and equipment, we'll have subsidiaries at 300. That is it. No effect on the income statement. So let's click on it. Oh, it went down by 300. As I said, this one went up by 300. Again, My current assets went down by 300. My long-term assets went up by 300. Total asset didn't change. Therefore, the accounting identity remained. Total asset didn't change because my current assets of the cash went down, but I have another asset. So total asset haven't changed. And if total asset didn't change, it will remain equal to the total equity plus total liabilities. Beautiful. No effect on income statement. Okay? That's the effect of buying another company. So you can really say buying equipment, buying buildings, buying subsidiaries, they all have the same effect. If I pay in cash, my cash will go down and my long-term assets will go up. Okay? So far, so good.
So good.
Very good. One more transactions, which is very similar, by the way, to buying subsidiary, buying machinery. It's transaction number 9. The only difference is I have to define what intangibles means. And please, many students get confused between the following two terms, intangibles and goodwill. I'm not going to define what a goodwill now. We will define goodwill in the future. Many times companies, in my opinion, wrongfully combine them together. They shouldn't. They should have two separate lines, intangibles and a goodwill. I'm not going to talk again about goodwill. I'm going to talk about only intangibles. What is intangibles? You might want to write it down. Intangibles, it's where a company goes to another company and said, oh, wow, we heard that you develop a special formula. You develop special technique. You develop a special medicine. And you got a patent. Let's say you got a patent from the FDA. That's a Pfizer. Develop the vaccination. How to do the vaccination. They spend a hell of a lot of money. The money they spend, okay, created something for Pfizer. Now, let's say Amos developed a new company in Israel, and Amos don't want to buy from Pfizer the vaccination. I said to Pfizer, I want to produce it by myself. Sell me the patent. Sell me the right to use your patent. By the way, it's not a real asset, it's just know-how. How do I produce vaccination? So I write a contract with Pfizer, and I said to Pfizer, I want the right to produce 100 million vaccination shots. That contract is an intangible. I paid Pfizer money. The amount of money I paid Pfizer, it is intangibles. I got the right to produce. I got the right to use something intangible. It's not something I can eat. It's something to know how to do the vaccinations. I paid Pfizer 120, let's say in this example. I don't know what the store I gave in here, but whatever store it could be interesting, please do read it, okay? So intangibles, it's buying the right to use a patent or even buying the whole patent. If I bought the patents from Pfizer, then Pfizer cannot produce anymore. I will be the only one. But if I only bought the right to use for a certain amount, that will be like kind of a license, you can think about it. So that is an intangible. So what's going to happen? If I paid Pfizer cash, my cash is supposed to go down by 120. What do I have in my hand? I have a contract. I have a contract saying I can use it, and I paid for it 120. So by the way, you should have a line that says intangibles. So my intangibles will go up by 120, my cash will go down by 120. Again, my current assets will go down by 120. My long-term assets will go up by 120. Usually intangibles or a right to use intangibles, you will use it more than a year. Okay, that's why always, most of the time you'll find it as a long-term asset. Again, very interesting. Buying machinery, buying another company, buying intangibles. Let me click it and you will see. When I click this one, see what happened. The cash went down by 120 and my intangibles went up by 120. Again, total assets haven't changed. No effect on the income statement. No effect on liability, no effect on equity. But it does have effect that I have less cash and I have more long-term assets. So all those transactions, buying machinery, buildings, or whatever,
Excuse
reduce
me, doctor.
cash. Yeah.
Yes, on that part for intangibles, do you
Yes.
like pay it yearly or it's like just paying once?
I paid once. That's a very good question, by the way. We will talk in the future. I didn't put it as an example here. When you, let's say you're leasing is a different things. And we'll talk about it in the future. Not in this course, by the way. In the course of corporate valuation, I explained it and we dive into it deeper. But you're absolutely right. Theoretically, I really should talk about it in this course. I might add another example of lease. Why don't you write it down? Who was that? Jeremiah? Who was asking that question?
Was me, doctor.
Daniel.
Daniel. So Daniel is a perfect question. This is really leasing. And I think we should add another transaction for leasing for this course. So I will add it. Just remind me, Daniel. We'll do it together. We'll do it when we do it's as part of the framework for software engineering and how we will add a transaction like that to this template. So we'll learn about templates, how do you add a special plugin, and then we'll add it there, and then we'll come back and we'll add it to the accounting as another transaction. Beautiful. That will be leasing. I won't get into that today. Okay, but again, beautiful question. Let's move on. Next one. Another things, by the way, it's very naive to think, hey, customer just come to the store buying shoes, they have a profit, I pay interest to the bank, okay? But there's more than that. Many times I need to pay some salary to the managers, don't I? Is that right?
Yeah.
Yes.
I need to pay for the buildings. I'm renting the buildings. I pay advertisements. All of those are expenses. Like I pay the interest to the bank. I also pay, some website to advertise. I pay the TV. I advertise in the TV. I advertise in the newspaper. I advertise in many places. All of those are expenses. There are usually two categories of how do I spend to promote or manage my company. One of which is sales and marketing, anything that has to do to promote or advertise or use employees to go place to place and try to sell my shoes, we call sales and marketing. The other category, it's when I pay rent for the buildings of the stores, when I pay my managers, and we're going to general and administrative. You will see in real life, companies combine those two together. I like to divide them to two categories, and they really should be divided. They're related, but they are really different. General and administrative is really running the company. Sales and marketing is really my marketing efforts. And many times, I would like to do I really spend too much on marketing? And that will come in the next session, not today. Okay, today we're talking about accounting. So if I spend on marketing, as I wrote here, sales and marketing, 110, and I paid in cash, and you can read transaction number 10 here, explained nicely, the company is paying for marketing 110, my cash is going to go down by 110. But this time, just like the interest, it's going to reduce my profit. The money is gone. So as the interest that I paid the bank reduced my profit, the sales and marketing going to reduce my profit. So what's really going to happen? What's going to happen is my cash going to go down by 120, by 110, sorry, by 110. So the cash is going up to go down by 110. And my profit is going to go down by 110. And remember, when my profit goes down by 110, the cash going to go down by 110, and the retained earning, or my profit, is going to go down by 110. So if the equity is going to go down by 110 and the cash is going to go down by 110, the identity going to hold again. Equity going to go down because the profit is going to go down by 110. The asset is going to go down by 110 because the cash is going to go down by 110. You combine those two effects together. When I click here, indeed, my cash is going to go down by 110. My profit went down by 110, which is really goes and flow to here, goes down by 110. The identity, the accounting identity remain. Total equity plus liabilities, 925, and total assets, 925. Very simple. So we can say that sales and marketing reducing profit just like the interest did. Next one is very similar. If I spend money on renting the buildings, paying employees, it's another money that goes out of the bank account, reducing my profit. So if I paying salaries and rent and everything's during the year, and the total was 75, what's going to happen? My cash going to continue to go down. It will go down by another 75. My profit is going to go down by another 75 because my general and administrative going to go down by 75. So if the profit is going to go down by 75, that means the cash going to go down by 75 and my profit going to go to 75. That means the accounting identity going to remain because this is going to go down by 75 and this is going to go down by 75. Let's see. Let's click on it. Click on it. Yeah, indeed. This is went down by 75. My profit went down by 75 because I have another 75 went down. And if this one went down by 75, the equity will go down by 75. The accounting identity remain as equal. 850 equal to liabilities plus equity, 750. Really nice. So we can say the effect of sales and marketing, general and administrative, interest, as long as it's paid in cash, they have the same effect on the financial statements. Profit is going to go down by all those three, by the way, minus 110, minus 75, minus 130, all of them reduce the profit. All of them, if they paid in cash, they will reduce the cash. We'll see other examples in the future in which I don't pay it in immediately, they will have a little different effect. For now, this is a very best understanding of accounting, very important to understand it, okay? Let's move on to the next one. Now, invest in commercial paper. What does that mean? What is commercial paper? What is commercial paper? Let me define it. Commercial paper is government bonds, stocks of another company, anything that I can take my money and put it and buy some papers, but they reflect assets. They reflect other entity. When I buy, let's say Uganda, let's say the US, let's say I buy, let's say this company said, oh, we have $14,000. We don't want just this money to stay there. Let's invest some of this money. Let's buy US government bonds. What does it mean? Like giving a loan to the US government. We said bonds are like loans. If I buy bonds from the US government, it's like giving a loan to the US government. Now, US government considers this very safe since you can buy and sell them any minute. They are very similar to cash. They are very, very liquid in the sense they are current assets. So if I bought some papers, commercial papers, meaning government bonds of the US government, I will classify them in a different category. I didn't write here commercial paper, but I could have made another category. Some companies will. I many times put them as other current assets. So commercial papers and other type of, maybe commercial papers in government bonds. I can buy other companies' commercial, bonds of other companies. I can, and you will see as we go along, it'll make more sense. For now, think about it. Commercial papers is like investing or giving a loan to the US government. And therefore, my cash will go down by the amount we spent 6,006. The cash will go down by 6. Other assets will go up by 6. So current asset will not change. Therefore, total asset will not change. Nothing changed in the liabilities, nothing changed in the equity. Therefore, the account identity going to remain. Let's click it. Bingo, you see, cash went down by 6. Other assets went up by 6. Therefore, 30 haven't changed. Total assets remained at 50, and total liability and equity went up by, stayed the same. And therefore, the identity that we mentioned in the beginning. Remember, I always go to that. It's very important. Then you know you didn't make any mistake. And this is just one case. Last one for today, and with that will include, next time I will do a review of everything, and we go over how that affect the statement of cash flow. So let's do the last one. Account for depreciation. That's a little tricky one. See, remember we bought machinery and transaction number 6, we bought machinery. How much we paid for it? 400. What happened when you buy a truck? What happened when you buy a car? What happened when you buy a machine? What happened when you buy a building? They lose value. The value of your car goes down over the years. The value of the machine that the company has bought will go down. You can view it. It's like expense. It's like, you know, the assets, the long-term assets don't worth anymore 400. They're worth less. If they're worth less, it means I have less assets. My total assets going to go down. If my asset worth less, that means whatever belongs to me, by the way, the equity is what belongs to the owner, will be less because the value of my assets went down. In another word, I will need in the future to use some of the profit to even replace it. So my profit, it's not really 168. It's true I made 168 as a profit, but my assets have lost some value. So I didn't really make 168. I really made less profit because those 40, I will have to replace them in the future. So my profit goes down by, let's say if the value of the assets went down by 40, and by the way, the name that we give to that, it's called depreciation. Depreciation you can write as the decrease in the value of your long-term assets. In this case, the machinery value went down, let's say by 40. That means my depreciation is 40. So my profit is going to go down by 40. The depreciation will be in the income statement. So my profit will go down by 40. The assets will go down by 40. Therefore, total assets will go down by 40. My profit will go down by 40. Therefore, my equity will go down by 40. Again, the accounting and identity will remain. Let's click this last button. And indeed, depreciation went down. See, depreciation, sales and marketing, general and administrative, interest, they are all reducing profit. My end results profit went down by 40, another 40. But at the same time as my equity went down by 40, my assets went down by 40. So my total assets went down by 40. My total asset is 810. And my total liability and equity went down to 810. Again, the accounting identity remained. That's the last point. It's a little hard one. As I promised, next time we'll do a review of all those transactions. And as I do the review, I will explain what is the statement of cash flow. So next session should be about cash flow, okay? Mostly on cash flow. And then the following one will be about financial statement analysis. So it will be a review plus statement of cash flow. That's next session. Questions, guys? Before I give you to ask even question, please go over this video. I'm going to send it to you guys. Go over it at least 30 times. Each transactions, please read it down, read it in the bottom. It's well described, well describing how it's affecting everything. And then review the video again and again and again. Even if you know it, even if you're sure you know it very well, go over it at least 3 times. Take my word for it. If you don't do it, even if you understand it, it's not enough. Understanding, it's not enough. Because we will build on top of it. And then all of a sudden, when I do financial statement analysis, I will say something, even if you understand it, your brain will not quick enough, it will not be quick enough to really understand the analysis. Therefore, please go over it at least 3 times for the next session. Questions, guys? Nobody had questions, or should I ask you questions? What do you say?
So one question.
Nobody had question. Michael, do you have any question?
I have a question.
Go ahead, Brenda.
You were calling the net income as the profit, but then how about the gross profit?
Oh, that's what we'll talk about when we talk about the financial statement analysis, by the way. This is the breakdown within. Thank you for asking, in fact. When we did the way I described every transactions, my brain was focusing on the effect on the income statement, the bottom line. But as we will see in the analysis, we would like to break down and we define gross profit, we will define operating profit, we didn't talk about taxes yet. Did I have taxes here? No, I didn't put taxes here. How come? I should. Okay, write it down, Brenda. We have to add, in addition to operating list or list, generally speaking, also taxes. They already should be there. Okay, maybe I gave it as an exercise, I don't remember, but we should really add another transaction. Next time, as I do the review, I will focus on, really is breakdown. You know, I have revenue, I reduce cost, I reduce depreciation, I call it gross profit. But the truth of the matter, I could ignore it, reduce the next one, reduce, get to net income. But next time I'm going to focus on why do we break it down to more specific sub calculations. It's very important. So that's excellent question. By the way, I never found not good questions. More questions, guys? Jeremiah? Mildred? Everybody happy? I'm going to start next session by asking you questions, and then I will do the review. Okay, so be ready. I will call on you. Okay, everybody must attend every session. You cannot miss even one session. Okay? All right, thank you guys. See you next week. And I will upload. By the way, let me stop the recording because that's